Hey everyone, welcome to another video. So today I decided to make a video on the topic what happens if your point of interest is missed. So there's a lot of factors to this. A lot of the times we're spending a lot of hours on the charts and we're doing our markups, and sometimes we actually forget part of the steps when it comes to doing our markups properly. Sometimes we forget to go to a higher time frame. Sometimes we forget to consider the entire range in a supply or in a demand zone. And sometimes we are just too over refined that sometimes our point of interest is missed. And so the idea behind this is when you're trading, you want to be quick to adapt, quick to react, and to understand that sometimes price is not going to give you perfect price delivery into your specific demand or supply zone. And so we need to be able to handle this and to understand that if our point of interest may have been missed, what could be happening on a higher time frame. Maybe the range was mitigated, right? Maybe we don't need to mitigate that point of interest because it's a little bit over refined, or simply volume and momentum have already entered the market and are ready to push price further away, right? Or sometimes we could be creating inducement, or we can be forming liquidity just before the POI, the point of interest, that later could end up being swept, to finally hit the refinement. And so this is going to be a fairly short video. It's going to be a lot more simple than the other videos. I'm going to give you three simple examples like I usually do in all my other videos. This is a markup that I've drawn. Now, this is based off of a question that I received in my Discord. So once again, if you want to join my Discord, it's free forever. The link is in the description. I do free coaching in there every week, and sometimes I get questions like this, and I decided to make a quick video on this topic because I think it's something that is very easy to go over with, like, let's say in the examples that I'm going to be giving you. So I'm going to give you examples on the 4-hour, 15-minute, and 1-minute time frames. So first things first, we're going to go over these specific this specific, let's say, cheat sheet, right? Or this specific like example. These are textbook like examples, right? Because this is the idea behind it of what it can look like. This will be very easy to digest. So from left to right, we have the highest quality example down to the lowest quality example on the right side. So ideally, right, whether we're trading pro trend or counter trend, whatever's happening, obviously we would prefer to be trading a pro trend setup, as there's more, the higher time frame is more in alignment, and volume and momentum are more in support of a pro trend move. But despite whatever the bias is, to understand is, for example, and you can imagine this could be, for example, a daily point of interest, a 4-hour point of interest, a 15-minute point of interest, a 1-minute point of interest. It doesn't necessarily matter the time frame. What the idea behind this is, for example, let's just say this is a supply zone, and this is a strong supply zone that broke structure to the downside. This could be a daily point of interest, and let's say the refinement can be 4-hour. This could be a 4-hour point of interest, and this could be a 15-minute refinement. This could be a 15-minute point of interest, and this could also be a 1-minute point of interest, right? So the idea behind this is, let's say, for example, this is our entire supply zone, right? And in this case, this would be our refinement. Let's say we know that this is the last buy to sell that is engulfing that breaks structure to the downside. This is where volume and momentum has been injected into the market and has caused a shift in price, a correction, if you will, from being in the pullback phase to go back into continuation with the higher time frame alignment, right? And so because we know this is the last buy to sell engulfing candle, we know that this is going to be the highest quality point of interest for us. Now, if price is, giving perfect price delivery, we would expect price to push back on the pullback phase in a very corrective fashion, right? In such a way that we're building liquidity underneath, so that when we arrive to our supply zone, right, this is a supply range, and that we are likely to come in to tap the refinement, that we get what is, for example, our change of character, a shift in order flow from, let's say, bullish to bearish, or in this case here, let's say, for example, if this is a demand range, for example, and this is our refinement sell to buy engulfing, you can imagine the price will be very corrective on the pullback before we come in, tap the refinement, give a change of character, signaling the shift of momentum and volume entering the market for higher time frame alignment and continuation, which is then what we'll end up seeing is an impulsive move to show us continuation with the higher time frame. So this would be an example of a supply, let's say a bearish form of, let's say, the best case scenario, which would be a lower time frame refinement inside a higher time frame point of interest is respected, right? This would be a supply version. This would be a demand version. So this would be the best case scenario. We have the highest probability setup, so meaning that if this setup does occur, the highest probability of success. And not only that, but we'll have the highest risk to reward. Because if we get an opportunity like this, for example, instead of being able to just set, let's say, our stop loss at the top of that range and enter, let's say, setting a limit, let's say this was 3R, now we can just protect the refinement, and we can take something that would be, let's say, like a 3R until like a 9R, 10R, whatever it is, right? Obviously, this is just giving you an example that we could refine this, and instead of taking a, let's say this was a 4-hour, we could take a 15-minute change of character inside. If this was a 15-minute point of interest, we could take a 1-minute entry from this refinement. If this was a 1-minute point of interest, we could take a 5-second entry refinement off of this 1-minute refinement, whatever it is. So the idea behind that is, more than anything, this would be the highest quality, highest probability setup. A change of character from the refinement inside of a higher time frame point of interest. Next to that, we would have, for example, a higher time frame point of interest that's respected. So, and sometimes this does happen. It happens quite often. Sometimes we will say that, oh, we've over-refined a point of interest and simply we missed our opportunity. And so when you are focused so much on one specific zone that you're dead set on price entering here. Now remember, nobody can predict the market. We have no idea what exactly is going to happen. But we can create our best case scenario idea, right? And so we should not be so overly fixated on certain points of interest because we will miss the opportunities, right? Now, for example, this one would be a highest quality setup. In this case, if this fails, likely we're going to run price much higher. In this case, for example, if we see the higher time frame is being respected, and as we enter the higher time frame supply range, or in this case, the higher time frame demand range, and we begin signaling a shift in order flow, momentum, and volume in the market to bring price from a corrective pullback phase back into an impulsive continuation with realignment of the higher time frame, right? In that case, this move is going to be very likely to succeed. But as we gave the example previously, we still have an unmitigated point of interest that is refined. That would be the highest quality zone to get an entry from, but does not mean that we will. Now we have a couple scenarios, right? More than likely, if we are trading pro trend using the B type setup, and we are getting a higher time frame, let's say respect, a lot of times what that really means is that we're going to be able to be trading with the momentum and volume that has entered the market, pushing price away from there, right? So obviously this type of setup would be favorable in pro trend because sometimes price gives us the opportunity to only mitigate the bottom of a range, and that's enough. Sometimes we don't need to come higher. Now I'm going to give you an example of this as well. And so sometimes we're going to miss that potential opportunity, but we have to be ready. For example, let's say if this is a 4-hour point of interest, right? This is a 4-hour supply. In that case, for example, this zone here, let's say we would be a 15-minute refinement. If we came into the 15-minute refined zone, in here, we could get a 1-minute change of character to trade away. But because we came into the 4-hour zone, we will not be able to use the refinement. And so the next lowest, let's say, time frame that we could use is if we come into the 4 hour, we would be able to trade a 15-minute change of character, let's say pushing price away from that point of interest, right? And so the idea behind this is this should hold, and it can hold, but there is a chance that we could potentially be liquidated. So sometimes what we end up seeing is price can do something like this, pull back until we have, let's say, a demand. And when we pull back to that demand, a lot of times price can push back up aggressively and sweep the liquidity that we just formed as inducement. Now, that's unlikely to occur if we're trading pro trend, because what happens is this supply, the higher time frame, is pushing price lower. Counter trend was the pullback, and so sometimes we get enough of a mitigation just tapping the bottom of the supply, or let's say just the top of the demand range, and oftentimes we do not need to come to here. So what we have to do is we have to be prepared. In that case, understanding that if we do get a tap over a refinement, then we can be pretty aggressive with our entry, knowing that we've been able to refine that zone many times smaller than the overall range, right? Now, if we come into the range, then we do have to be aware that we could potentially take a loss if we are, let's say, getting a change of character early on. What we could have is the formation of a failed change of character. A change of character, for example, in this case, that would signal bearish intentions, but then later be swept just to be able to form inducement below the point of interest. And then we would have to take a secondary entry, right? In some cases that will happen, so that is a risk, but it is a high probability setup. And so if you're trading with good risk management, there's no reason why to avoid taking a trade like this, because at the end of the day, if this does work, you are going to have many times more your risk to reward than you would if you just took one loss before you hit a winner, right? Sometimes a trade could present itself like this, and then you end up seeing price, basically liquidate the initial movement away, basically giving us a failed change of character, and then we would get something like this. And in that case, you can take that entry because you know that that one's going to be even higher probability. So if you took the first loss, not a big deal, right? Now, the next thing that happens, this happens all the time, and this is something that you're going to see is pretty popular a lot of times. So sometimes what happens is we are taking into consideration a pretty big range. And so what happens is this is a change of character that happens outside of our point of interest. And this is something that I think a lot of people don't realize how often it does happen, but it can be an easy fix. And so for example here, if this is a 4-hour point of interest, for example, and if price comes into our 4-hour point of interest, we may only need to see a 15-minute change of character. If this is a 4-hour demand and we come into this demand, we only need to see a 15-minute change of character, right? Now, if we are outside of the point of interest, what do we need to see? If this is a 4-hour supply, outside the point of interest, we would need to see a 4-hour change of character. Now, if we see that, that's great, and that's enough to take that trade, even though we have not come into a higher time frame, let's say supply or demand zone. Sometimes that's still a valid trade, and sometimes it will still hold. Now, just like I said previously, this would be a lower probability setup because there is a chance that we will be liquidated. Just as the previous example, sometimes price will have to come back to that area, but at the same time, we have to have that understanding that it's not always going to give us perfect price delivery. And if you can catch a good 5R off of a trade like this, 10R, or if this ends up breaking the leg and creating a new low, right? This could be structural inducement for the next point of interest that might pull back to that zone. But don't stray away from these type of entries because these are valid and they still will work. And so just be understanding that you have to have good risk management, and while they're lower probability doesn't mean that they're not going to work, right? Now, a lot of times what happens is this can be part of a fault of over refinement, and sometimes we're not considering the entire range. And so, for example, if we're so focused on a 4-hour or 15-minute point of interest, sometimes we are refining our point of interest, not realizing that the entire supply range in itself is valid. Apologize for the barking. So Let's get into the examples now. So we have example A, for example, where we have a tap of the refinement. We have example B, where we have a tap of the higher time frame point of interest missing the refinement. And then we have an example where, for example, we may have tapped the bottom of the range, but we may have not tapped the actual higher time frame point of interest in itself either, right? So let's get into it. I have 3 examples here. The first one's going to be on a 4-hour time frame. So here we can see this is EU. This was actually recent price action. This was during March of this year. So if you understand basic market structure, what do we have here first to the left? This would be our supply zone. This was a strong supply zone that did break structure to the downside. And what you can see is that we created this pretty strong leg bearish to the downside here. This is where we had our low. Excuse me. This was our low. We made a pullback. Price pushed back up. We made this high, right? So this was the higher high of this leg because we had we were expecting a lower high, right? Then price pulled back. What do we have here? We have a higher low, right? Then now what do we have? A higher high. We're expecting price to basically build liquidity below this point of interest so that when we come in to tap it, we will get a nice entry with inducement to be able to take out all these legs, understanding that the higher time frame is bearish on the daily time frame, right? Then what do we have? We have a lower high, we have a higher high, and at this point what do we have? We have a change of character where we basically fail to tap our 4-hour point of interest. Now in this case, for example, we do have to understand that after we have a break of structure, we can expect a pullback phase to initiate. Typically, it will happen inside an opposing higher time frame supply or demand zone. So for example, when we had this first break of structure bullish, right? This was on the 4-hour. We have full body candle closure above the previous wick high, right? And once we have that, we can expect a pullback, right? Now, if price came into this POI, that would have been perfect, and we would have expected to take a short to take out both of these lows and to make a new lower low, right? But because we have not yet tapped this, we were not really expecting a strong supply to take out the low, right? So that's exactly what didn't happen, right? We would have a higher low, and then price does what? Another higher high. Break of body, break of structure with a body candle closure above the previous wick. Here we have. Now we know we can expect at any moment to have a pullback, but at the same time, we very much expected, being so close to this POI, that we would have this tapped. Now what happened? Well, we did get a 4-hour change of character, considering this was the last sell to buy that made a new high. This would be our 4-hour change of character right here. So let's mark that out properly. This was where we had our sell to buy, where we made a new high. This was the high, and once we took out this level, we saw that we had a 4-hour change of character. Now we have, for example, let's read this. Sometimes coming into the higher time frame range is all we need at the current moment. The current reaction can later serve as inducement. So we did have the potential expectation that this could be inducement for the POI above, and we were expecting until we have the 4-hour change of character, the price could come back into demand, push up into here, and then give us a signal to go bearish, for example, right? And that's where we would take our point of interest. Now, in a 4-hour point of interest, all we need inside of it would be a 15-minute change of character. So outside of this point of interest, as I mentioned previously, what would we need? Outside of the 4-hour point of interest, we would need a 4-hour change of character. This was a low that went with this move to the downside. So here we have this supply, and we're going to look at it on the 15-minute, right? But the idea behind this is a 4-hour point of interest. Inside of it, we needed a 15-minute change of character, but outside of it, we need the same move. For example, another 4-hour change of character bearish to signal a reversal outside of the POI that we would consider taking. Now we understand that the higher time frame is bearish, and so we don't necessarily need to come into this point of interest because there might be enough volume and momentum entering the market. It could be from news, it could be for any reason. A large order enters here we don't necessarily need to come into this 4 hour. So if we were so fixated on this, we would totally miss this trade. Had we caught a 4 hour change of character, you totally would have been able to get an entry off of this on a lower time frame, which I'm going to show you how we could have done it. Now, in this case, what was also something that we missed? Well, a lot of times we focus so much on our specific time frames, we miss that, well, this was also the daily point of interest. And so we've already had one tap of this point of interest. This one already basically created what? Equal highs inside of the POI. And this was a liquidation that gave us a 4 hour change of character with a 15-minute entry in here. So why would we have needed to tap the 4 hour, understanding that we were already inside the daily point of interest? That's what happens. Sometimes we forget that we are so much time is spent on the lower time frames that we forget where we have another point of interest. So for example, let's look at the daily here, right? We didn't get a candle body closure below this until down here, right? But if we look at it like this, right, this was the low, this was the high, we swept previous liquidity, right? And this was the high that ended up breaking structure to the downside, right? So we have this high, right? And then this is the low that we made where we have a pullback, right? So this was a big move in itself. If we look at this range, for example, we can see that if we looked at the 4 hour in itself, the 4 hour is above the 50%. The 50% would be here, and this would be a 4 hour. This would be a well-priced point of interest. But most of the daily is also above this point of interest. Maybe if we even looked at it on the 12 hour, potentially we could have seen it even better. So here, look at this. If we looked at the 12 hour, this is our 12 hour point of interest. This is technically the last buy to sell that gets engulfed to the downside, right? Here we have another one. Obviously, we've already taken this level initially, but if we look at it on the daily, which is the higher time frame, and it is a very valid time frame, this was the last buy to sell in premium pricing before we created the last part of the leg down, right? And so, while we could have focused, for example, on the 4 hour refinement, we should have also acknowledged and gone to the higher time frame of the daily, understanding that there is that chance that we could have had something like that. Let's see, did this even come into the 50%? Let's see. We did not come into the 50%, but we were pretty darn close. How many pips away were we? We were less than 2 pips shy of the 50% of the equilibrium of that trade. So idea behind that is sometimes we're not taking into account the higher time frame range. And so when we understand that instead of being so focused on a 4 hour point of interest, also understand what the order flow is showing. And so when we saw this, even if we did not know we were in a daily time frame, if our point of interest was a 4 hour and we had a 4 hour change of character, that's pretty strong enough to consider taking this a bearish trade off of this. So for example, here's where we had the last reaction to this demand in here. This was sell to buy that made a high. This was a wick basically where we had this was basically a buy to sell engulfing. This is where we had the last that's where we broke. So if we looked on the 15-minute, once we had that change of character, this is a candle that gave us the break bearish. So now what do we have to look at, for example? Well, let's look at this we're on the 15-minute time frame, so now we're looking at some markups on here. So for example, this was the low that created the high. This was a 4 hour change of character. We would not take a 15-minute change of character because on the 4 hour supply, if we didn't tap the 4 hour, we cannot refine our entry to the 15-minute, right? Because we're not in a higher time frame zone, right? So in this case, we would need the 4 hour to shift. The 4 hour gave a change of character. Now what could we consider? For example, if we look at it like this is like a flip, right? So we have this demand. This is a sell to buy engulfing to the upside. You can see we broke structure to the left on the 15-minute. This was a strong demand. We didn't really have any inducement, any liquidity below here. And what did we do? We have a corrective buildup here. We have some liquidity here that, we could take. Let's mark it out. Price then, it comes shy of our point of interest. On the 4-hour, we're about 5 pips shy. Here we push price propels down, taps into this demand, the last sell to buy engulfing, gives us a little reaction in here, price plays around, and then this is where we have the last 15-minute candle that's a buy to sell that breaks the 4-hour. So once this changed character, this went, basically this, we would then look at this entire leg here, for example. This would be the leg that formed. This would be the swing on the 15-minute. And this is a 4-hour change of character. So based on that, we would understand that this is strong, right? And this should not be broken because we have a 4-hour change of character bearish, right? And so how would we pick our point of interest? In this case, we have to understand, well, we have two potential point of interest. When it comes to this flip, for example, we could also look at the extremes, but a lot of times what we don't realize is that the point of interest that we come back to give a reaction to, it's either going to be the point of interest that pushes price in, it's going to be the last sell to buy or buy to sell that pushes price into the point of interest, right? Which would be, this would be the demand that caused the flip, right? Or it's going to be the point of interest that broke the last buy to sell or sell to buy that broke the actual demand or supply. So in this case, we have point 1, which pushed price into the point of interest, and we have point 2, which is the one that is responsible for breaking the demand. It's demand failure, right? And so ideally, usually the one that ends up working is the one that has the better inducement. In this case, we see that price did come into this area here, and this was a very close tap, very small, depending on spread. Maybe you would have gone tapped or not. But you can see that it comes to fill the imbalance between this wick and this wick. But it does come to tap this supply. And so this would have been a valid entry on a 15-minute. Now that we had 4-hour change of character, we could have taken the 15-minute entry off of this level here. And you potentially could have even gone to a lower time frame. Or now that you understood price is bearish, we could have taken another entry somewhere lower in the leg, right? But that's the idea behind it. This came shy of a 4-hour point of interest. Instead of completely missing that opportunity, right? If you could have, it would have been wonderful to have a daily point of interest, right? Because if we have a daily point of interest, what would we be looking for? A daily point of interest, a 4-hour change of character would be perfect for a daily point of interest because that's the next time frame lower that we would use. So daily supply, once we tap into daily supply, we need a 4-hour change of character, right? We did not see the daily supply, that's fine. If the 4-hour is our point of interest, in this case, a 4-hour change of character would be enough to show that likely we would not come back to here. And as you see, if we go back to the 4-hour, we did not come back to that point of interest. We were shy of it. Let's move that. And look where price is now. We simply did not need to come back to mitigate it. This was enough. 4-hour change of character, you could have gone a 15-minute entry that would have done what? 4 hours changed character, that's on your side. The 4 hours stronger than the 15-minute. We could have targeted this low and had a wonderful entry. Now, I'm not here to show you where you would have entered from, this and that. I gave you the idea. That's kind of the focus on this video. We're not really talking about the entries too much in itself. But that's basically the idea for that. Let's go to the 15-minute example here. Okay. So for example, let's look at, there we go. Okay. So in this case, the 15-minute is bearish. So we're expecting bearish breaks of structure, right? So for example, this was the low, this was the peak high, this is the highest point, the extreme of this bearish break of structure. Once we break structure, body candle closure below the wick low previously, this is confirmation. What is the highest point? Is this one, right? So this is going to be, let's say this would be A, B, this would be C, right? So this would be what? This would be the low. Here we would have, in this case, looking to the left, especially knowing we're bearish, In this case, this isn't necessarily, we were not bearish yet. We did have this break of structure. This was the pullback. And in here, we do have some 15-minute bullish structure. But this is basically the bearish order flow part of this leg that aligns with the higher time frame. So we know the daily and the 4-hour are bearish. And so we're expecting the 15-minute bearish to continue to hold, right? And so, for example, here order flow is bearish, so we break structure to the downside. Let's say here we have a clean low, we have a pullback, we have the same thing. This is the highest point. What do we have? This was a lower low. We have what? A lower high. We make a lower low. Price pulls back. We have a lower high. We break structure to the downside, body candle closure. We have a lower low, right? And so here, what do we have? This is the highest point, the extreme of the bearish break of structure, right? And then so what happens here? Here we actually have a shift. So this was the last high that basically made a low. So if we're going to have a change of character, this would be the 15-minute change of character. This would have to go for the 15 to be bullish, right? And this would have to be a breaking closure above here for price to give a bullish break of structure. This would be 15-minute change of character. This one would be 15-minute break of structure. So we make this low. Price is now in a pullback phase. As we broke structure, we can expect a pullback. But ideally, we would respect this supply, this high, right? Because this is technically protected and strong. Price then gives a little pullback here. We form a nice little sell to buy engulfing. Price pushes higher. Here we have a wick through the high. So we have a 15-minute change of character. Price then gives us a sell candle here as a reaction to the extreme here. So we have a sell to buy, then we have another sell in here, and then what happens here is we're stacking enough buy orders to create this long wick, and we end up with a 15-minute break of structure that's bullish, right? And so at this moment we have to think, okay, well, now we have a 15-minute change of character bullish, and we have a break of structure 15-minute bullish. So technically that now makes this low protected, as this is the lowest point before we have this break of structure. Now you can see how aggressive this swing was. As you can see that from this low we made this high, right? So this was the previous A, B. Now we have this C. And so now we have to think, what would be our point of interest? Ideally, and this did happen to me, this was April 19th, around that time, I was looking for price to come back into here. The way I thought about this is a very clean point of interest, right? This is a sell to buy engulfing. It's the extreme of this push to the upside, right? But something that we have to think about. Well, we have 2 point of interests, right? In this case, even though this one was responsible for the change of character and did contribute to the break of structure, this is the origin, right? The extreme of this. As well, we have some orders in here, some buy. This is a potential point of interest, but more than likely would be these. And so, for example, what we could see is that this is a supply range. Now, we could say, for example, that we have, let's say, the supply zone would be something like, let's say like this, right? And that we gave a reaction in here. It didn't really take any liquidity. We could see something like that. What we could also say is, in this case, for example, if we look to the right side on the leg that did break to the upside, break of structure, well, we have 2 points of interest, right? We have the one that pushes price into the supply, right? Which would be on the higher side of this area, right? This was one push to the upside. And then we have the point of interest that is responsible for breaking the supply, right? In this case, failure of the point of interest, right? And so in this case, I would prefer to see price come down to here. But I also understand that what we did form is another range. And so instead of me seeing that we have a, let's say, change of character in here to go bullish and see price leave without me, what I should have recognized is also understanding that we formed a demand range. We have this high to this low, and we broke to the upside. And so this would be the demand range. This was the supply range, this low to this high, breakout from here. So this was the supply range. This should be respected, right? As the higher time frame alignment is bearish. But the moment that this went, we have this new swing to the upside. We have this high, this low to this high, right? Let's mark that out, right? This would be the swing leg. And so price, although I wanted to see, let's say, a higher quality point of interest hold, we can see that technically this was enough. This came into the demand range. And while it may not have been a very well-priced point of interest, this is the demand, the sell to buy, that is responsible for breaking the supply range, like this, right? This was a supply previously, and technically this is the one that broke it. And so it is a very valid point of interest. And you can see that that point of interest holds, and the low of this demand never goes. We have sweeps of internal liquidity in here. We have some inducement building. We have a last sweep in here, but this demand is respected completely. And so in this case, same thing. Sometimes we have to understand that a refinement isn't always going to be tapped. That would be a case of something like this. Well, my point of interest that looks exactly like this, it's basically on the demand side, a sell to buy engulfing. This is where I wanted to get my point of interest. But the reality is price didn't need to, because although my point of interest was refined, I do have a demand range that could be respected. And if I see a change of character on that time frame inside there, that should be enough for me. Look at this. This is the demand range. We broke out here. This point of interest is a sell to buy engulfing, very clean. That's the refinement, right? Ideally, I would have seen that. But in here, we have many opportunities where we could see a better, let's say, for example, a better entry off of here, right? That we could have taken something off of even on a lower time frame. This held, and it makes sense. It's the top of the range, didn't come to the refinement, and that's fine. But once this happens and this goes, we understand that we don't need to come back to this one until we complete the higher time frame intention, right? So we don't have to be stuck looking for that move, understanding that this could be enough, this is enough in that moment, and we don't need to come back to it for a while, right? As you can see, price kind of soared after that. All right, so now let's look at the last example. Hopefully these are clear and they're not too confusing. Let's go into here. And let's do this. Okay, so this would be the 1 minute. I know a lot of people love to spend time on the 1 minute, right? And so sometimes when we're on the lower time frames like the 1 minute, we forget, well, that we have a supply or demand range, same thing as previous, right? So if we look a little bit to the left here, we have this low, we have this lower high, we make a lower low. This makes a swing to the downside here. We have a pullback. Here we make a lower high. This high is lower than the previous high. We're expecting to make a lower low. This is the lower low. We break structure to the downside. So technically, this should be protected, right? And this should be targeted. The low of the move should be targeted. And so we should see this go as long as price is in alignment and decides to continue with that higher time frame intention. Now, one thing is we're expecting a pullback, right? And looking at this, for example, this leg in particular, I very obviously see a buy to sell in here. Now, one thing that I don't like about this point of interest on this time frame is that the sell does not engulf the buy candle. So here we have the buy candle, we have the sell, we have a pause, and then this is where we end up pushing through. This is a weak candle in a way because we basically for a whole minute we're in here pausing and we're not really making much progress on engulfing. More than anything, I can see that this is the area where we end up being engulfed. This is a sell candle where all the volume and momentum enter to push price lower, right? And so many of us would probably be fixated on this specific 1 minute point of interest. And whether or not we decide to include the entire buy candle because it wasn't engulfing or whatever, I could have seen myself potentially waiting to see this get tapped, right? Sometimes coming into the higher time frame range is all that's needed. And so what we forget is what is the last sell to buy that makes the high? Well, here we have, for example, we make this high, we pull back. This low makes this high. We pull back, here we have a little wick. This fails to make a new high. So technically, this low to this high is the last sell to buy where we make the high. This is a failed attempt to make a high. So this is basically the area that we want to look for. This would be the bottom of the range from this low to this high. And so if we decide to mark that out as well, understanding that there is a chance that, well, our point of interest may not be the best quality, and this could potentially satisfy the move enough. This was the last time where this low made a high. After that, we failed to make new highs. We just have a little bit of wicks equal highs, right? And this we know is where liquidity basically entered the market. But more than anything, this range, anywhere in here, price can come in to get tapped. Now, if we want a different time frame, for example, maybe the POI would look way more clean. For example, here on the 2-minute, this looks like a very obvious buy to sell. And we could very obviously get confused and think that this is exactly where price will come into. This is a liquidity point of interest. Maybe we're waiting for the 50% to get tapped. And as you know, price does not come into that area. So let's look at what we could have done differently for this specific zone. So this is the case in terms of where the refinement was not tapped. So let's look back here. That would be an example of this again, where we have a refinement. In this case, could be over refined, but sometimes that the bottom of the range is enough. And that's where we have to understand where to draw the range. Instead of focusing so much on a specific point of interest like this, also be aware that we could totally miss it if the bottom of the range gets mitigated. And so we have to be aware that sometimes that's enough. And so we looked for the last low that made a high. We marked that out, and you can now see, while we have corrective buildup of liquidity here, these are relatively equal lows. Here we have a sweep of that liquidity. Price is then pushing to the upside. Here we have a lot of relatively equal lows. This is like trend line liquidity building up into this point of interest. We get the first tap, no change of character. This would be the low that pushed into that high, right? That did not go at that moment. We respected the demand. Price then pushes back up into this point of interest and does what? Here we get a reaction and get a change of character. This was the furthest point away, the low, from this high to this low to a new high. This gives us a change of character on the 1 minute. We made this low. Now what we do notice is that there's no inducement for this point of interest, not necessarily inside of this range. So what we do have is we have this is outside of that range. Technically we can say that the last sell to buy would be here. We're going to make sure we mark that out properly. And technically this was formed after breaking out from that range. And so that's not really inside of the range inducement, inside range inducement. This would be outside. So in this case, we could say, well, maybe this will get liquidated in itself. Now, if we were going to take an entry on this, what we could say is like, okay, we did get a change of character bearish. There is a chance that this is going to be the reversal point. We can be aggressive. Let's just set an entry at half of this, let's say half of that, and cover the high, let's say with a half a pip. Let's say this is 2 pips. Let's say we just move this a little bit higher, we cover it by half a pip, whatever potential entry, and we would be able to get in on something like this. But what is something that I did mention that we have to be aware of? In this case, well, there's always going to be a chance if we do not tap the refinement that we could be liquidated. We could be liquidated because this is the inducement necessary for the point of interest above, that's the refinement, or simply because this is going to be enough to sweep where we no longer have to tap the refinement and we could just continue lower, right? And that's exactly what happens. So when you don't have price tap the refinement, we have to understand that there is a chance of being swept. We could basically have a failed change of character, which is what we had, as this gave us a trap for early sellers that pushed price lower. We have that change of character bearish. A lot of people would be getting in on something like this, and if they set their stop loss at the high, they would have been liquidated even if it was by 1/10 of a pip, right? That takes the high. So that's enough of a sweep, right? And so we could have taken an entry off of different things, right? We could have set an entry off of here. Let's say we did get taken out from the first high, right? Let's say we did cover the high. If we covered the high with like a small amount of like 0.3 pips or 0.5 pips, good, you're in this, understanding that likely we could have been swept. If you didn't, that's fine. We do get other potential opportunities for an entry. when this is the last low, sell to buy, that makes this high, and this goes, let's mark this out properly, just for this example, right? This is the sell to buy that makes this high. This area does not surpass this high, so this is the high. Once we have this wick through, we can look at this, for example, in a couple different ways. What pushed price into this point of interest? We have, this would be the demand, right? Same as we talked about earlier. So this is a sell to buy that made that high. Price gets pushed into this area here, gives us a flip, doesn't really take any liquidity, and then ends up breaking. Here we have a break of that point of interest. When we continue, we have body closure. We don't get it until down here, which is pretty low in here. So we can think about it like this. We have 2 points of interest. We have the one that causes the break, right? This would be the second one. And then we have the one that pushes price into the point of interest, which would be this one. And so in here, for example, this would be the last buy to sell that pushed price in here. Now we do have these wicks, for example, that are buy to sell price action. So in here, we have this supply. And we do understand that inside here, we do have some inducement. So this could have been the inducement, and we could have narrowed a stop loss to use this as inducement and just cover this, right? And so we would always be able to get an entry after. But the whole idea behind this video is to understand that don't get so fixated on a specific point of interest, because you're not always going to be getting tapped. It might be a beautiful point of interest. I mean, look at this. It looks great on the 2 minute especially. You can see that we're stacking sell orders in here. This is the last buy to sell before we have an engulfing change of character, right? We're signaling a lot of reasons why this point of interest should work, but never discount the range, because if on that specific time frame you have a change of character on the time frame that you're looking at price before you get into the refinement, that could be enough, right? So be aware. What I'm going to add to this chart for the actual cheat sheet that you're going to be able to download in the description is I'm going to add the time frames that are going to be relevant, meaning like if this is a daily, this would be a 4 hour. If this is a 4 hour point of interest, you need a 4 hour change of character. I will add that to this sheet, and so by the time you download it, you'll have it on there. But the whole idea behind this is don't discount the ranges, be aware of where price is, and if you get a change of character on that specific time frame that you're looking, just have good risk management and understand that that trade could work out for you, and don't sit out on the sidelines too much to where you continue to miss trade opportunities. So I hope that this helps you change your trading, and I hope this helps you take some new wins for next week, and I hope you have a beautiful weekend. We'll catch up next time.